Hey everyone, happy Thursday, March 6th. It's about 11 a.m. on the West Coast, and it's time for another market update. Mortgage rates had another good week. The markets are in turmoil. Stock markets are down quite a bit. Crypto's all over the place, but overall, mortgage rates had a pretty good week. We got some big inflation data at the end of last week and some jobs data this week. So let's get right into it. Starting with, like I said last Friday, we got the January PCE inflation data, and the CPI report earlier in the month came out hotter than expected. So I think the markets were worried that would happen again, but this basically came in right with expectations, and that was a good thing. That was no surprises. It was a good reaction by the markets. They reacted well. So like I said, across the board, headline month over month came in at 0.3 as estimated. Year over year stayed at 2.5 as estimated. Core, which we know the Fed's paying the closest attention to, takes out food and energy prices. That was at 0.3 as estimated, and month over month stayed at 2.6 as estimated. So it actually might have come down if they hadn't made a revision to the previous month a little bit higher from 2.79 to 2.87. But then shelter is still a little elevated, coming down slowly, but we know not keeping up with real time. Healthcare, which makes up a big percentage of it, was negative month over month 0.13, which was interesting to see. That's usually a bigger one. Prescription drugs jumped quite a bit though, so that those, for whatever reason, those prices jumped in the month of January. And then as you see, the 3 month rate, so basically the 3 month average and the 6 month average for the core, which we know the Fed wants to get to 2%, was at 2.4% for 3 months and 2.6% for 6 months. So not a huge amount of gain there. We're not getting really closer to that 2% number. And then looking forward, keep in mind we're replacing in January the core, that 0.3 number replaced this 0.5 number from last January. So we got some gains there. That's the difference. But if we just keep running out 0.3s, as you see, February will be higher than last February's. March a little bit below, and then after that, quite a bit above. So we want to see that core come down more than that, or else we're going to start seeing that core overall number go up with these replacement numbers. And then same thing here with shelter. Shelter, we know this should be coming down, but these numbers start getting a little bit smaller too, so we won't get a lot of help there. So it'll be important to see what happens there, looking at the numbers. But on the flip side, this week, Scott Bessent, who's the U.S. Treasury Secretary, came out and said he thinks that 2% inflation is achievable, and he gave two reasons here. He gave oil. He thinks oil prices, because of production and things like that, will come down, and that will help. Oil is not part of core, but it trickles in there because basically oil and gas are used across our country to get goods here, and that gets baked in the prices, even if we're not looking at it in that core number. And then the second part was deficit reduction. So this has to do with a lot of the changes Doge and Elon Musk and whatnot are doing with cutting spending. He thinks that will help inflation come down, which is probably true. The other thing he said was the 10-year could move lower. 10-year Treasury yield, that's directly connected to mortgage rates. The spread, basically the difference between that 10-year and mortgage rates is a little bit, historically it ends up being, right around 2%. It's been more like 2.5 for a while now. I think 2.4%. So he thinks that will continue to narrow, which should mean even if the Treasury yield stays where it's at, mortgage rates should start coming down. And then he also said the housing freeze should unlock in a few weeks. That would be great to see. Not in a few months, not in next year, but in a few weeks. So I'm all for that. Let's hope that Scott Bessent is correct with that. That's an optimistic take, so that's great. Next thing, like I said, we got was February's ADP private payroll, and this was a big miss. Came in a lot lower than expected, and they made a revision to the whole 2024 number. So supposed to be 140,000 jobs created. There were 77,000, and then, like I said, they revised 2024 by negative 215,000 jobs, which is about 17,000 jobs per month. So that would be a big help when those numbers come out. But again, this is a revision, so we're not going to get the same reaction. Business size look like small lost jobs, where medium and large added a little bit, but not again as much as they expected. Leisure and hospitality continues to lead it. Construction, manufacturing, education, and health services down quite a bit. That's usually a big gainer. Maybe that's some of this trickle down with the Doge stuff and government changes. And then wages, wage inflation. The more we make, the more we spend. That's inflationary. Job stayers stayed the same at 4.7% wage inflation, and job switchers went down a little bit, 6.87 to 6.7 year over year. So overall, again, we get the BLS jobs report later this week, tomorrow actually. But with this ADP one, at least that came in our favor with showed the labor market showing some weakness, which we want to see. Initial jobless claims missed. It was supposed to be about 234,000, came in at 221,000. Continuing claims did go up quite a bit. So, this is another one that's been relatively low for a while now. It'll be interesting to see with all those government changes if we see more people filing for unemployment and we see this number start to go up. Miscellaneous stuff. So the first one, let's look at this. This was an interesting chart. So the Atlanta Fed does their GDP now. It's a real GDP estimate for basically they're trying to get ahead of quarter one for 2025. So the blue chip consensus, all the banks, everybody's consensus, it's right about 2.3 or so, I think was the median. That's kind of where they were too. You could see, going back in January, they had it at 4, started coming down. And lately, with all these changes, it's fallen off a cliff. They're now predicting instead of a 2.3% gain of a GDP for the United States in quarter one, they have it at a negative 2.8%. That's a big drop. That's borderline recessionary. That just shows a big economic slowdown. Kind of expected, they made these changes based on a lot of these economic policies. Tariffs, Doge, letting stuff like that. So it'll be interesting to see if that holds fruition. So we're still at the very beginning of a lot of these policies, so it'll be interesting to see how it all plays out. But historically, tariffs tend to be inflationary. They tend to sometimes slow down if we don't do as much business between countries, things like that. So right now, at least, the stock market and stuff didn't like all this stuff, but mortgage rates liked it because we looked at it as more of a slowdown economy, which tends to lead to better mortgage rates. Where does that leave us? Average 30-year actually touched, I think, 6.66, 6.67 earlier this week, which was the lowest in 4 months. Last couple of days, it's gave a little bit back based on some of these changes, actually. Some of these, tariffs being rolled back a little bit with some, exclusions and stuff. So we right where we were last week, 6.79. So it's good to see we're firmly in the sixes. But again, that can change tomorrow with this BLS jobs report. The BLS jobs one, let's hope it follows this ADP report and shows lower job numbers. The lower inflation is and the less strength the job market shows, the better chance we have of the Fed cutting rates. Right now, the Fed, less than a 10% chance they cut rates at their March 19th meeting. So this number would have to come in really low, maybe on unemployment spikes. This CPI, the next inflation report at the beginning of March, middle of March, that comes in good inflation. Maybe they think about cutting rates, but right now it looks like they will continue to pause. So, like I said, great week. Let's hope it continues. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.